Hey everybody, welcome to the Global Ledger, where we explore the system beneath the headlines, the plumbing beneath the prices, and the liquidity beneath the narratives. I'm Justin, and I want to start this podcast exactly where I believe everything else starts, and that's with liquidity. Now, I'm not here as a guru or someone who claims to know everything. I'm just someone who's been trying to understand how money and markets really work. And the more I learn, the more I realize that liquidity sits at the center of everything. So today, I want to share what I've learned, what I'm still learning, and why I believe liquidity is the single most important and most misunderstood force in modern finance. So if you turn on the financial news or even scroll through social media today, you'll hear kind of the same ideas over and over again. Things like the Fed prints money, it's all manipulation, markets moving because of headlines, interest rates went up, so stocks must go down. These ideas are simple, and simple ideas tend to spread fast, especially when markets are moving and fear is high. But here's the truth. Most of these explanations focus on the surface. They look at prices and not the conditions beneath the prices. So markets don't move because someone said something on television. They move because liquidity changes. So here's the simplest way I can put it. Liquidity is your ability to transact, to buy, to sell, to borrow, to settle. And finance is the world built on top of that ability. So, liquidity isn't, dare I say it, vibes. It's not hype. It's not headlines. Liquidity is balance sheets available to make trades. Dealers willing to take the other side of that trade. Funding conditions, collateral terms, margin requirements, and the ability to convert one asset into another at par, the same price. When liquidity is abundant, you'll see markets feel smooth, they feel stable, they feel confident. When liquidity dries up, even the best assets can feel broken. So when we look at that, valuation of these assets is about cash flows and discount rates. But where do discount rates come from? They come from funding conditions, which means valuation starts with money. And money, well, the modern kind, starts with liquidity. So one of the most important things I've learned from a guy by the name of Perry Merling is about dealers. And this is something he would say. Dealers sit at the intersection of money and finance. And it can't be more true. Dealers are not just market makers. They are balance sheet managers. They're the ones that connect the funding markets, the hedging markets, capital markets. They're the ones that connect valuation. They're the ones connect global dollar flows, central bank operations, which we'll get into more. But when you buy a stock, a bond, or a derivative, a dealer is often your counterparty. If their balance sheet is stressed, your asset can't really trade easily. So, in the inverse, if their funding is expensive, your discount rate will expand. So if their collateral haircuts rise, your asset price will fall. This is why liquidity comes first, because when dealers lose their capacity to intermediate, the entire financial system becomes fragile. And this is no matter what the economic fundamentals say. So let's connect this up with something. Let's connect this with your portfolio as an example, and we'll give you kind of a chain reaction. I've got 7 basically chain reactions here. I've got written down. So number 1, when liquidity conditions change, funding costs change. So that's number 1, too. Number 1, liquidity conditions change. Number 2, funding costs will change. Going to number 3, dealer balance sheet capacity would change. Risk-bearing capacity changes, be kind of that next chain reaction. Then discount rates would adjust. Then valuations move. Prices respond. So, and most people skip to step 7, the price, without ever understanding steps 1 through 6. But that's where the truth is, and the truth is often not scary. It's just mechanical. So here's kind of, or here's really where it gets global. So most of the world's trade, this is trade, debt, derivatives, and funding, happens in dollars. So even if it's outside the United States, this is the Eurodollar system, the offshore system, the hidden system, call it beneath the central banking system. So when global dollar liquidity tightens, everything tightens. This is emerging markets. This is real estate, credit spreads, equity volatility, commodity pricing, even crypto liquidity. So when global dollar liquidity expands, everything breathes easier. So understanding global liquidity is really the closest thing that we would have to a master key. Why begin the entire podcast with liquidity? Because if you understand this one concept, every other part of money and finance becomes clear. Banking, the Fed, valuation, risk, credit, what else? Markets, bubbles, crashes, inflation, recessions. You get the point. They all trace back to liquidity conditions. That's what the global ledger is all about. So I'm here to try to peel back the layers, slow down the story, and understand the mechanics behind the moves, replacing fear and hype with clarity. And together we'll explore the funding side and the valuation side and everything in between. So thank you for listening to episode 1 of the Global Ledger. These will sometimes be a little longer, sometimes be a little shorter. But if this brought you any clarity, share it with someone who might also appreciate a calmer, clear way to understand money and markets. Next episode, we're going to dive deeper into the global dollar system and why it quietly governs almost every asset price in the world. So stay tuned. I'm Justin, and thanks for being here.